On today's show, 3 questions. Number 1, did you miss inflation? Number 2, how quality are U.S. dental schools? And number 3, are DSO deals ramping up in 2026?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
And Rob, yeah, you are. And Rabih, you're checked out. We already established this. Let's just get it out front right now. You've got the quintessential proverbial senioritis. Tell us why, Rabih. Why are you checked out today? What is happening? We got to be honest with the people of why you're just, you may not be here fully mentally. We're going to keep you here, but it's going to be a challenge.
But don't say that, because my next topic is pretty technical. So just heads up.
We're basically giving you a built-in excuse. If you say anything that doesn't sound right, your energy seems low, there's a reason. You want to tell everyone why?
Oh yeah, I don't mind sharing. Well, I'm walking the talk. Everyone knows I'm a big foodie on this channel, right? It's other than being a nerd, I'm a foodie, and I'm actually going next week, so you won't have me here, man. I'm sorry.
I know. I miss you already.
Thank you. Love you. So next week, I'm going to be in China for 10 days on not tourism, not like a visit to do trade deals, none of that. I'm going there on a food, just to eat for 10 days and come back.
You're not going to go meet up with Gigi?
Well, if he joins me for lunch, sure, but I'm not skipping my lunch schedule for him.
Yeah. It's so cool what you're doing, and something that I'm so jealous, like my younger self is so jealous of like, and it's so cool to see that you're so into this, you're so into cooking and into food and all this. And the fact that you're like, I like that you said you're walking the walk, that you're spending your money on creating experiences around something that you love and not just saying it. So I think it's so cool that you're off to China for, you said 10 days?
10 days.
Wow.
I'm super excited.
It's going to be so fun. Well, you haven't left yet, so let's focus up. Let's talk inflation. Okay. What's going on, Rabih?
I'm gonna try not to daydream about noodles as I talk about inflation. But did you miss inflation, Matt?
No, I did not miss it.
Unfortunately, it seems like the macroeconomic regime that we entered, which is diagnosed with labor market where it is, GDP growth on par but nothing outstanding, and higher oil prices, that was the new addition, is now becoming a new normal. And with that new normal, everything else has to adjust next to it. And given that oil, I'm not going to say the military operation 6 weeks versus not 6 weeks. I'm not going to go into that. But what I'm going to say, oil prices have been up in the high 90s to the hundreds for above than 6 weeks. And when we collect data on monthly basis, we are going to start to see that trickle in, correct? So what has happened is a lot of stuff lately, mainly a big inflation footprint. But also we had some other stuff related to the Federal Reserve that I'm going to hit later. But let me start with the inflation. I'll get your opinion on it, and we'll take it from there. So the CPI report came in. And the CPI report has been, fluctuating in the range of like the 2.7, 2.4, etc. In March, it came in hotter at 3.3. And we were like, oh, this is the first time it jumps below that trend. And then April data came in and inflation is at 3.8. So if we're adding 0.5 every month, well, next month, the inflation from 1 year to another is going to be 4.3. And the month after, like 4.8. And like at this pace, in 4 months from now, we're at 6% inflation, which is not a low number, right? There has been a rapid increase. And this is all inflation. Just a quick reminder, the CPI is just a basket of goods. They are stable. They are fixed. It's not like they rotate out of that basket of goods. And it's what, the people at the Federal Reserve think, or the Bureau of Labor Statistics think that this is what Americans spend on. It's shelter, it's groceries, it's energy, like electricity and gas.
Basic needs of life.
Apparel, it's medical stuff. all of these. So that headline number that includes everything, from one year to another, we are recording inflation of 3.8%. That should be around 2. So it ticked up. If you exclude the most volatile aspects of inflation, which are usually energy prices and food, and this is what we call core inflation. Core inflation has ticked up from 2.6 to 2.8. So core inflation, the one where we would panic if it goes up a lot, is still at 2.8. So most of it is still contained in energy, actually, not food yet. In core inflation, the biggest two kind of that are getting affected is one is apparel. And I'm guessing this is more of like cheap goods. And I would guess those are imported and those are impacted by transportation costs. They are volatile, but apparel was averaging around like no inflation, 0.1, 0.2, minus 0.1. And just from December till now we are at 4.2. So we were at 0 and apparel just skyrocketed up 4.2. And then we also have shelter, unfortunately, which is one of the main important ones. But shelter was trending down the whole period, and we ticked up from 3% inflation to 3.3% inflation overall. This is the state of the economy. This is where we are seeing pockets where prices are going up, but it hasn't become contagious yet across everything. The only ones that caught that contagion have been slightly shelter because of like interest rates being affected, and apparel. Food hasn't. The other stuff that we spend money on, such as medical care commodities, education, new vehicles, services, those haven't gone up yet. But if they do, warning.
And I'd imagine that we'll see, like, this all comes down to the prolonged, number one, this jump, I think we can attribute to what's happening in Iran.
100%.
And then Hormuz and the Strait and oil. And I would imagine the trickle effect is basically just contingent on time, like how long this actually lasts, because I don't think it's a far reach to say, well, oil is volatile, which is why we pull it out of the CPI figure. But oil, like the price of oil is one thing, the ripple effect of oil in the actual economy and it rippling to all these things, again, this comes down to the longevity of this conflict.
100%. And the way it trickles down into the economy is that oil affects anything that's being transported. So suddenly, all your food's getting transported. I was actually talking to everything that's being transported, even within the country. Actually, I was talking to a family member the other day, living in Montana, slightly away from, from busy cities, which is an amazing idea to think of. But because you have to ship groceries and vegetables for a longer duration, their tomato prices are like twice what we see where we live in Salt Lake City, for example.
Yeah.
Right. So this is how it starts showing up. Suddenly, from your perspective as a consumer, well, okay, my groceries are now more expensive, right? And then later on, well, my clothes are more expensive. My medical bills are going to be more expensive. And that is how it would trickle down into the economy. So far under control, but the longer it stays, the more, it would happen.
Well, what's interesting here too, Rabih, and is that we've talked about this before, but the layer on top of this being a midterm election year, we all know that politics drives a lot of other decisions that the government makes and controlling the narrative and all this. So it's super interesting to see this tick up, and obviously what's happening with Iran, and it's just interesting to know what's going to happen here, knowing that extra pressure that, for example, Republicans are feeling right now, being, in control, let's say, but the pressure they're probably feeling of being able to control this narrative or shift this quickly. You wonder what that does to just their approach with Iran that maybe has nothing to do with Iran or what their original goal was. But that's what's so confusing and interesting about this.
Did you know where I was going? This is a great segue.
No, I didn't.
The administration right now has kind of a wild card in their deck that they're going to be using. And that is the new chair of the Federal Reserve, officially confirmed, Kevin Warsh, ladies and gentlemen. Okay, so we are.
Are you in the honeymoon phase right now? Or are you still filling it out?
Maybe he got confirmed by the Senate. I get over breakups really quickly, if you guys have noticed.
Jay Powell is so last month. Yeah.
So Kevin Warsh was affirmed by the Senate. And Kevin Warsh has been, coming into this scene where he is like handling Fed independence head on and saying, well, the Federal Reserve and the Treasury should kind of have an accord with each other. Fed independence does not mean that they do not coordinate on how they would want to
work together,
steer the economy. So will Kevin Warsh be facing new challenges? Probably, because he came in saying, I'm going to reduce interest rates for everyone. And not to prevent inflation from happening, I will shrink the balance sheet of the Federal Reserve at the same time. What that means is that they're going to sell bonds on the side. So it doesn't have they're going to mute the impact of lower interest rates. Then suddenly inflation is coming back in. Lowering interest rates when inflation is, starting to brew is not a good sign. Like, no textbook tells you that this is going to lead in the right direction.
It's only going to make it worse.
If you thought 2022 was bad, if they decide to cut interest rates, it's going to be worse than 2022. In 2022, they did nothing. So that is going to be, although this is what he pitched as he was being confirmed by the Senate, it's the odds, it's not going to be happening. And what I mean by the odds, we don't have to wait to see how Republicans would act or how the war in Iran would show or what grocery prices is going to be like. The market is ahead of everyone, like it always is. So we can look at the prices, and there are two data points I want to highlight to you today. The first one is the yield on the 2-year Treasury bonds. The government issues Treasuries and it borrows. It could borrow for a year, 2-year, 10-year, 30-year. The 30-year Treasury is now above 5%, by the way, which hasn't happened in a while. But if we look at the 2-year interest rate, the 2-year interest rate is very similar to the interest rate that the Federal Reserve decides to set, which is the 3.75% right now. The 2-year interest rate, if it deviates away from that one, because it tracks it really slowly, tells you that, hey, the markets kind of have an opinion that the Fed is going to change their stance soon. So most of the time, and when the 2% is very close to the interest rate that the Federal Reserve sets. Before 2022, the 2-year interest rate jumped up to like 1.5 while we were still at 0, like a month or two in advance before the Federal Reserve had to say, okay, we're going to start increasing interest rates. In 2023, 2024, when the Federal Reserve was holding rates at 5% and said, we will start cutting at some point, but not yet, the 2% interest rate started dropping a couple of months before they started cutting. They are counting in that rate is that of the 2 years from now, so it should be lower.
Yeah.
Now we look at what has happened this last week, and this is like very fresh data. What has happened the last week and a half is that the 2% interest rate was on par with the 3.75, which is the official rate by the Fed, but it has now jumped up to 4. It jumped up by 0.25 or a quarter of a 1 percentage point up. So they would expect the Federal Reserve to start hiking. Now the market thinks from between today and 2 years from now, interest rates are going to be a quarter percentage point higher. This is what the market thinks. So if this is the signal the market is giving the new chair of the Federal Reserve, then probably the new chair of the Federal Reserve is not going to go and cut interest rates. That is the first thing. The other piece of information that I wanted to share with you is related to a data that we always mention on this podcast called the Federal Fed Funds Rate, which is futures. So it is what the markets kind of is betting on or expecting interest rates are going to be like. And I looked at what interest rates are expected to be like in December. So from now till December, because we can't really predict 1 month at a time, in December, last month, back in mid-April, they thought that there's a 65% chance that interest rate stays where it is and a kind of 25% chance that we will cut it and then other percentages scattered around. Dominantly, the idea was interest rates are going to stay where they are. Fast forward to today, there is kind of a 50% chance that interest rates stay where they are, but instead of them being cut, there's a 50% chance that they're going to go up. That says a lot. This says, and this is where the signal is. The stock market broke an all-time high this week, although it retracted Friday. The Dow was back up above $50,000, right? NASDAQ and S&P made all-time highs. These are noise. The true signal is where the bond market is moving and shifting towards. Odds are changing. And these odds are very data dependent. So depending on what data we get in the next couple of months, depending on what the new chair of the Federal Reserve, Gavin Walsh, is going to say in 30 days from now in his first meeting, will dictate how everything else is going to be trending.
Yeah, and so this, I like that you're doing this of saying stock market's noise. We really need to be looking at this, and I'd imagine, Rabih, all this just indicates that we've seen, as you mentioned earlier, slight tick up of inflation, but this short-term yield and what it's telling us, and the odds changing. Is it safe to say that's meaning that it's indicating that this inflation threat feels real? It feels more like it's going to sustain as opposed to be transitory.
Well, obviously, it's in our short-term memories. I know the economy was frothy in 2022, and people had much more money and were more optimistic about the economy than they do right now. So higher oil prices really tipped us over the cliff really quickly. But right now, higher oil prices will still tip us over the cliff. Maybe not at the same speed. Higher supply, like oil is a raw commodity that comes into our costs. We need oil we need to supply oil into all of our economic components to let the economy run. If those increase in prices, if the origin initial input increases in prices, it has to be reflected everywhere else. Like it's a very mechanical system at that point. How long it stays high depends on whether companies can stomach that higher cost or they'll have to pass it on and make it go through the economic loop.
Yeah. What a flip, Rabih. What a flip. We went from,
I know.
Rates were for sure getting cut to probably not, to rates might actually be going up.
Yes. The good news is inflation, we say, demand and people like panicking and consumer confidence is very short term. All it takes is like for them to cut interest rates and everyone will feel euphoric again. Inflation in the economic sense, in the textbook sense, is what we call something of a medium term. So inflation can come and they might hike interest rates, and then suddenly the Iran war might end and suddenly there's a pent up amount of oil that's going to flood the markets and oil prices will crash. And maybe that will trigger even more inflation because now people can even spend more in an inflation environment. But all of these, in economic sense, are considered medium-term effects. So yes, will it change the path that we were expecting for the next 3 to 5 years? Surely. Does it have any impact or relevance or importance when we are looking at the economy from a 10-year lens, 15-year lens, 20-year lens, which matches the investment horizon? Absolutely not. For those long-term lenses, all what matters is labor supply, how much you've got people to drive the economy to produce more and increase its capacity, and how productive is that labor, right? As long as you can bring in more humans to do the work or generate robots that can do that work and make those humans more productive, whether through new skill sets or an AI that can help them, in the long run, this is what keeps the economy growing. Forget about rates, forget about inflation. Those correct themselves.
Yeah, that's a good nuance. You're saying that even though these yields are specific, like are noise, are signal, not noise, they're signal. But you have to also apply that to signal over what time frame and what lens you're looking through versus how that matches up with your investment time horizon. So I think that's a really, really good distinction. That yes, it's signal, doesn't mean it's relevant to you if you're a long-term investor.
100%. I have an analogy. If your back hurts at 18, it's a signal, but it's not important. If your back hurts at 30, be careful. Right?
Wow.
This is how it goes.
You're triggering me.
I'm sorry, but I also have back pain.
We share this. And I was like, what about 39 when you get back surgery? What does that mean?
Matt and I bond over our physical ailments.
Exactly. We do. I just happen to be 10 years older, so my physical ailments have really, really solidified. I'm a cautionary tale for you. Yeah, that's what I am. Okay. Anything else, Rabih, on that? It's really good to break that down. And I think shift mindset of what I'm hearing, what I've heard from a lot of people is like, oh, rates are coming down. I think it's just kind of a vibe. Like, I think rates are going to come down. Don't be so sure. Not so fast. So, okay, as we shift, Rabih, we have to mention that segment was brought to you by the Dennis Money Summit, right? Which is coming up soon. So that whole segment was sponsored by the Dennis Money Summit coming up June 11th through the 13th in Midway, Utah. Definitely should be there. I would imagine that you'd agree with that, Rabih. We bond over our back ailments and also the fact that the summit's going to be an incredible event.
I'm like, actually, after my trip, I have nothing else to look forward in life but the summit.
But the
Like, I'm
summit,
super excited for that summit. Super excited to meet, clients that we've known across the years. And honestly, I sit behind a screen, right? So for me, it's names and numbers. But when I meet the people in person, I put a face to it. And it's just so much more rewarding. So come
so
along.
fun.
We'd love to meet you in person.
One little thing here, if you're still considering it, signing up, one little thing we want to mention, we are booked. The main hotel is booked, is full. So there's a hotel across the parking lot right next door. You can go to dennismoneysummit.com. You can still come. Doesn't mean you can't come. You won't be able to attend. Just know that if you go to sign up or you go to register and you realize, oh, there's no hotel, it's the homestead, which is right there, right? It wouldn't even be like a drive. It's literally a walk. But just know that if you go to Dennis. So dennismoneysummit.com, check it out. This next segment is sponsored by, I don't know what, by us, Rabih.
Okay.
No. Okay. We want to talk about the quality of the U.S. dental schools. This was brought to us by Becky. Shout out. She posted this in our internal thread, and I thought it was actually really interesting to see a couple of different things. Number one, where does the U.S. rank just across the world from a dental school perspective? And then they also added here the cost of these schools, which I'll be honest was rather surprising. So what I'm looking at here doesn't give the total 50. It gives a couple of top ones that I'll mention. There's a school, Karolinska Institute in Sweden, the University of Hong Kong in China, and the Academic Center for Dentistry in Amsterdam in the Netherlands earned the top 3 spots in the QS World University rankings. So there's the top 3.
None of them in the U.S.
None of them in the U.S.
Okay.
So those are the top 3. I guess I should say this first. The rankings compare schools across 5 categories: academic reputation, employer reputation, research citations per paper, H index. I'm not sure what that is, Rabih. You may know, but which measures, right here. It's reading it right here. H index, which measures productivity and impact of academics and departments, and then international research network. So there's a whole deeper methodology, but that's kind of the broad categories. So the top U.S. program, which has, by the way, been the top U.S. program for 4 consecutive years. Rabih, do you want to guess? Do you want to give it just throw it out there guess?
This might be the least confident I ever made a guess on 2 cents. I'm going to guess, is it a school in California?
It is not. That is the second ranked, though, is a school in California. So that is a very good guess. Let me see if I can see here. There are 2 schools in California in the top 10 of for the U.S. specifically, and the top 50 for the world. And the second ranked school in the country in the U.S. is a California school, but the number 1 is not. It's Midwest.
I'll pass.
Okay. It is the University of Michigan, Ann Arbor.
Oh,
is the top ranked for the 4th consecutive year in the U.S. It's the number 4 ranked school in the world and the number 1 in the U.S. I'll just go through these. Number 6 in the world, but number 2 in the U.S. is University of California, San Francisco. Number 3 in the U.S., 13th in the world is Harvard. Number 17th in the world, 4th in the U.S. is University of Pennsylvania, Philadelphia. Go Birds. Then it goes to North Carolina, Chapel Hill. Next is University of Washington in Seattle. NYU is next. And then University of California, Los Angeles. And then University of Buffalo. And then Tufts University, Columbia University. And then rounding out the top 12 in the U.S. is Boston University. So those are the top or 12 of the top schools in the world and the top ranks ones in the U.S. So then I just wanted to add this really quick. This actually was a little bit surprising, just to add a layer of this, Rabih, of some of these schools not as expensive as I thought, specifically for residents. So we don't need to go through each one, but I'll go over the overall average. Attending the top U.S. dental schools in the U.S., the average for residents for all 4 years was $222,382.
Okay.
for a resident. Does that seem low to you?
Well, if I did not work at dentist advisors and see the student loan values that dentists rack up, I would be surprised because it's definitely much higher than average residency if you're just in medical school on its own, right? Especially at lower universities. It is high. Dentistry never ceases to, surprise me by how expensive it is.
Yeah. Yeah. And I this says dental school costs. I don't know what I think this might just be tuition. So, because we see a much higher number on average, I will say non-residents for these top 12 schools is just over 303,000. But I believe this is saying average 4-year tuition. So the
Okay.
reason we'd see larger balances is because you can't be working in dental school for the most part. You're going to be racking up more costs for living and things like that. So this is just for tuition. Uh, anything you want to add on this? I just thought it was interesting data to hit the top 12 in the world.
Yeah, I was so interested. So out of the top 12, how many were American and how many were not?
In the U.S. So these are the top 12 universities in the U.S. The rest are all outside the U.S.
So out of the top 50 in the world, 12 were in the US. That is what
Correct.
you said? Oh,
Yep.
okay.
Yep. The rest of the top schools are outside the U.S.
Over 20% market share, kind of.
Yeah,
Like
there
over
you go.
20% of all the top, 20% of the top 50 schools are in the US. That is a strong standing.
Yeah.
And actually, you notice it. Like, if you travel outside the US, there's a stereotype that the Americans are the tourists with the whitest teeth, right? Like they say that about Americans when they are traveling. So
Yeah.
that makes sense.
Yeah, it does. It is interesting. I just thought when I saw that data, I was like, oh, this is kind of cool. And I thought it was interesting that Michigan has just dominated the U.S.
Yeah, that
for
surprised
the
me.
last 4 years. So, okay, moving on. Final topic here. Our DSO deals ramping up in 2026. Rabih, what's the first thing you said to me when I brought that up before we started recording?
I said I'm not surprised because IPOs are ramping up.
Yeah.
Right?
Yep. You said IPOs are.
IPOs.
Yeah.
Do you want to hit IPOs and then we'll go
Yeah,
to
go ahead. Yeah.
So IPOs are just short for initial public offering. So the first time a company goes onto the stock market and lists its shares on the stock market, so anyone could buy them, just like you buy shares of Apple, etc. That activity or announcement is called an IPO. They go and they ring the bell in the stock exchange and all of that stuff. IPOs are a method by which a company raises money. So they could either go to a bank and raise some money so they can do business, or they can do an IPO, sell shares to the public investors, retails, us like us included, and then they would pocket the money to probably grow the business even more. Because you are raising money, you would want to raise it at very favorable rate for you. Just like when you go to a bank to take a loan and you want the lowest interest rate possible, the equivalent of that in the stock market is that you would want to have an IPO when the stock market is very expensive, because that means you are raising a lot of money.
Yeah.
So when we start seeing the stock market going up, like the Dow at 5,000, 50,000, or all-time highs due to tech stocks, etc., you would start seeing these very big companies that were private start listing themselves on an exchange through an IPO. And that is for them to raise money cheaply. No honorable mentions or notable mentions that might happen this year are SpaceX, OpenAI, and alike, right? So just like raising money through equity requires higher prices seen in an IPO, the mechanism is kind of similar in private markets for smaller businesses. And this is where you're going to hit it. DSOs come in, right?
Yep. Yeah, exactly. And I'm glad you took that out kind of more to the macro level of DSOs are, according to this report, expecting the same increased activity, to your point, as IPOs are. Although there are some unique challenges that DSOs are facing. And I'll just hit this really quick. We interviewed Mike Baird, CEO and founder of Accelerate Dental, a couple of weeks ago, a month ago. I can't remember. We do so many of these, my blackout. But we talked to Mike pretty recently, and he highlighted a really sharp decrease in deals over the last 4 years in particular, to the point where by the time the data he was reviewing ended near the end of like fall of last year, in 2025 up to October of 2020, or up to October of that month or that year, we'd only seen 4 recapitalizations with DSOs. So that was from 16 in like 3 years prior to that. So deals have definitely slowed in the DSO space. And I wanted to highlight. So we're gonna talk about. Well, first thing I'll just mention. This is from Becker's Dental and DSO review, and specifically they quote a report from Tusk Practice Sales. They are a healthcare M&A advisory firm. This is nothing to do with Tusk whatsoever. Like as a company, sure, they're a great company, but I will say right off the bat, you just have to understand the source. This is an M&A advisory firm releasing this report talking about activity. Just connect those dots, right? Okay. You got to read between the lines.
Align the interests.
Yep. Yeah, exactly. But Tusk, according to their report, there's a couple of key items, but one of the biggest ones they said is 69% of DSOs surveyed indicated their private equity sponsors expect a moderate or high increase in acquisition activity in 2026. Now, this was a Q2 report. This was a report taken, or they published in just a couple of weeks ago in April. We have not seen this yet. So maybe it's going to be a second half of the year increase. We're not seeing it personally, not saying it's not happening, but we have not seen like a significant increase. 78% of DSOs anticipate recapitalization within the next, they say 1 to 3 years. Maybe, could be, but again, not seeing it. Any thoughts on that initially, Rabih?
Actually, I can't decide what is the more dominant factor that drives a DSO, event or sale. Is it because valuations become, high, valuations become high and people are more incentivized to sell their practice to a DSO at a higher price? Or is it because of stuff demographic? Like, are there now more and more dentists who are reaching retirement age and they would rather just exit through a DSO and that's why they expect the increase? Or is it purely just because valuations are higher and now more people are incentivized to sell at higher prices?
Yeah, what's interesting is right now, so I don't know the answer. I really don't know. Yeah. I think one of the main reasons being, if I had to guess, is more of I don't know if you'd call this demographic, but I think it's because deals dried up and we're in a steep decline over the last few years, and because there's been a lot of, I think, kind of wait and see approach by the private markets, private equity specifically, and specifically in the dental space, I think there's been a lot of just dry powder. And there's a lot of cash been accumulated by these groups. And we've talked about this before, but, and Rob, you know way better than me, but the way these private equity deals are structured is there's a shot clock. You know, these private equity groups have raised capital from very wealthy people or wealthy institutions that are acting as what we call LPs. They're the limited partners. The general partner, the GP who's running the show of like picking these investments, they can't just be sitting around. They got to be deploying capital. And so I think a lot of this, I don't even know if it has anything to do with like the market in dentistry as a whole. I think it literally is just maybe some urgency of like, we've got to get some deals going.
Dude, this is one of the biggest conundrums with investing, because I feel like for people who manage money, there are two types of people. There is the type that tells you, we do not know how markets would move, but opportunities arise and we are going to uphold the standards of patience, discipline, sticking to the plan, and being very abusive of when the opportunity arises. And then there's the other type of people who manage money, which I see, and not just in DSOs, for people who manage mutual funds who approach us, all types of stuff, who tell you, oh, we are investors who go out, search for opportunities, and we're going to keep bringing you deals, which upholds this value of we are smarter than everyone. We actively bring them. We actively make the money. Where in investing, it's more of like planting a tree than it is, or going fishing, where you want nature to cooperate with you versus you building a house, right? So there are two approaches to investing. And in the case of private equity in general, DSOs in specific, the way they pitch it is that we're going to go out there and find you the good opportunity. We believe good opportunities show themselves as a no-brainer, right? Yeah. Warren Buffett believes good opportunities show themselves as a no-brainer. You don't go and search and squeeze out an opportunity. Yeah. So when you set the expectations that you're going to go out there as a GP to the LPs that, oh, I'm going to go find you dental practices and we're going to create this DSO fund. I'm going to squeeze out return, and nature does not, cooperate with you, you're in a corner. And this is exactly what you might be talking about. It might not be within dentistry. It's a feature of how sales happens in the investment world.
Yeah, it's a great point, and it's really something to keep an eye on and be thoughtful of, not only in your own investment experience, but particular to how these DSOs and who's back. Like, that's why it's so critical to understand who's backing the. If you are considering a DSO, let's just say you are, it's critical to understand who's backing them, what's the mechanisms they're dealing with, what's their structure, what's their timeline. Really important to know that. That alone can tell you the quality of a deal. Are they playing the same game as you? I think is what we're saying. And oftentimes they're not. They're really not. So the last part of this I want to hit that's super interesting is this. And you tell me, Rabih, if I'm thinking about this right. But there seems to be a bit of a contradiction even in this, like the surface level areas of this report. They're saying they're expecting a pretty significant increase in activity, but then they're also talking about some of these unique challenges the DSOs are facing from a growth perspective. In particular, DSO right now they're claiming a high demand, low supply environment, and so I think they're just I don't know what they're indicating as demand.
Yeah,
like there's a lot of practices wanting to sell, but there's just not a lot that are quality enough to buy. But they do indicate that the scrutiny on these deals is increasing. That they're being much more selective on what practices that they're purchasing, and look no further than kind of the next these are all connected, the next demand or the next challenge, and the reason they have to be more focused on scrutiny is because of the overall environment right now. We're talking about interest rates and inflation and all these things happening. That is a massive impact on these deals. And we are no longer in this stage of what we were in a few years ago in the DSO space, where they were just sprinting to consolidate practices to flip basically in a really low interest rate environment. That's gone. Like that,
Yep.
that no longer is the case. So they're getting really, really a lot more focused on and have a higher level of scrutiny on the deals they're actually selecting. So again, that kind of tells me activity may increase, but there's some unique challenges they're facing right now that is going to restrict them from increasing too much.
Yes. Industries that deal with smaller firms where funding is very important get hurt when financing costs are high. In English, what that means is when interest rates are higher, businesses that flip businesses, right, can't be as profitable. And we are, as we mentioned in the first segment, right, that we are in an macroeconomic regime where interest rates are going to be higher because there has been inflationary pressure on some commodities. This is not saying it's bad for business overall, but for this type of business, the business that thrives on doing financial gymnastics with their math, it's tough on them.
Yeah, definitely. The other two, just to wrap this up, the other two challenges, the unique challenges the DSOs are facing this year, within economic challenges, we mentioned high interest rates. The other thing is just being operating costs are higher. Individual practices are feeling this, so are DSOs. And at scale, that problem can become exacerbated and cause some issues. The other two that they mentioned is increased oversight. So there's a emerging hurdle that DSOs are facing with just increased oversights on transactions and pushbacks from industry leaders that are really focused on protecting, patients and creating autonomy for these doctors and not letting this. I kind of highlight this around kind of the topic of like not consolidating power to too small companies within a pretty niche space as is. So there's been increased pushback across the board depending on the state. And then the last one being decreased Medicaid funding. With the one big beautiful bill, we know there was some pretty significant cuts to Medicaid. That's shrunk Medicaid budgets and has impacted, again, depending on the state, has impacted some of these larger groups as well. So some unique challenges. They do claim that there's going to be some growth and activity. Again, we haven't seen it. If you're seeing it, let us know. If you're in a state where you're like, oh man, they've really picked it up, we'd love to hear and correct ourselves. But from our end, we have not seen this. So more to come. Maybe it'll be a second half push.
It might be.
But if rates keep going up, I'm not so sure. Rabih, anything else on this or anything else we've covered up to this point?
Nope, I love it.
Okay. All right. Well, we got to send you off to your trip. We're going to miss you,
I'll
Rabih.
miss you too.
Next week's going to just not be the same. I don't know. We can't fill your shoes, but we'll do our best.
There's still time. You can pack your bags and we'll record the session from China.
Yes.
I'm totally down.
I would, yeah, we're not, I don't share this. I'm actually the opposite end of the spectrum on the foodie scale. I'm just like totally good with you. As you know, I'm just like Chipotle is my jam. Just keep it simple. Nothing that's going to knock your socks off. But, well, enjoy your trip, Rabih. Again, we'll miss you, but I know you'll have a great time. If you're out there listening, you're needing help, you have questions, you've got concerns around your investments or your anything to do with your financial plan, we are here to help. DentistAdvisors.com, book free consultation button. We would love to hear your story. We talk to hundreds of dentists all over the country every single year. We'd love to talk to you and see how we can help. Again, that's DentistAdvisors.com. For now, Rabih, thanks for being here as always. Again, enjoy your trip. Travel safe. Everyone, thanks for listening. That was our 2 cents. Till next time, have a great weekend. Bye-bye.